Hey everyone, welcome to another episode of On The Flipside. On the first Monday of every month, we talk about any topic in mindset. And every other Monday after that, it's any topic in real estate. Now, my name is Diana Lizarazo, and today's guest speaker is Jacob Perez. And before we start talking about the show, I want to share some exciting news with you. I have created a social networking platform called Refam, and it will be transforming the way real estate investors, mentors, and professionals work in the real estate investing industry. It also solves two critical problems: building trust and credibility, and visibility, becoming searchable. So if you're looking for that, you can get into my bio for sure, but you can also go on my website, and that's Real Estate Investor Fam, F-A-M, realestateinvestorfam.com. You can learn so much more. There's so many other features that it does, and you'll love it. So now back to our show. On the flip side, our guest speakers are real estate investors, and they're here to help you by sharing their knowledge. And today's topic is how to transition into multifamily investing. So let's get Jacob on. Send us some hearts, send him some love, and let's get him on here. Fire, anything you'd love to send over just to show our love and welcome him on the stage. Let's see, are you getting it? I am accepting. I may cancel it and send it myself. One sec. I don't know why these days. I just sent the invite to you. Let's see if it works. Oh, we got it. Hey, Jacob.
Hey, how's it going?
I'm good. How are you?
Doing well. I gotta get a tripod for these lives so I don't have to hold the camera the whole time, but I'm doing well.
Yeah, that'd be a good idea for sure. So let's get started. Let's start with just telling the viewers a little bit about yourself. What's your background in real estate and just in the real estate investing industry? And anything else you'd like to share about yourself before we get started?
Yeah, so if anyone's tuning in and hasn't met me personally or heard me speak at a conference or something like that, I've been investing in real estate about 10 years now. Crazy to say that, but a full decade investing in real estate. And like most investors, started with the turnkey simple projects, then started taking on conversions and more value add type projects. I've experience with burr strategy, joint ventures. But in the last few years, I've really focused on scaling through apartment buildings. So taking, apartment buildings around 20 units, give or take, repositioning them and then refinance. And then now I'm really starting to push into the new construction space around apartments as well. And professionally for the last 5 years, so not as long as I've been investing, the last 5 years, I've been a mortgage agent and we specialize working with investors. And really excited to talk about this topic, transitioning into bigger multifamily projects, because that really seems to be the appetite everybody kind of has right now. So really happy to help people with that.
Awesome. And I totally agree with you. Like the numbers aren't working in the small, like the single families or the small multis, and a lot of people are moving over. And there are differences to it. And so which one would you like to start with first? What kind of differences, what is the main difference that you think people should know about when getting into the multifamily?
Well, there's a lot of differences, right? The biggest difference is that the financing and the way you approach financing is very, very different. So when people are approaching investing in real estate on the normal residential side, usually they'll go to their bank or go to their mortgage agent and they'll figure out, okay, here's what I qualify for, and I qualify with in the A lending space or the B lending space. Whereas in the multifamily investing world or multifamily financing, it's really, what is this building in combination with me qualify for. So you kind of have to unlearn a lot of the things you think you know about residential investing and relearn the process for commercial. But I would say probably the biggest difference that people need to be aware of is that timelines are slower and it's not as easy when it comes to big multifamily projects just to tie something up and figure it out as you go. It definitely requires a lot more preparation.
Mm-hmm. Yeah, I completely agree. So talking on that side of the so what kind of things should they even be aware of to make sure like they should even be starting the process? Or for example, like what I'm talking about is like you go to make offers on multi-families, and on the financing side, like what are things that they should be aware of to make sure even they qualify, or like those pre-steps that they should be kind of taking into consideration?
Well, I think at first it's going to be similar. You want to approach a mortgage agent, one who has experience with commercial investing, and you want to establish some version of a baseline of what might be possible for you, right? Mm-hmm. So when it comes to tying up a deal or conditional periods or things like that, I think you just have to be prepared for a lot more due diligence and learning a little bit of nuance. So for example, if you're buying a residential property, you might ask for a condition of finance, maybe a 5-day condition of finance or 2-day or 7-day. Whereas on the commercial multifamily side, you might want a longer period. Let's say 30 days due diligence, 45 days due diligence, but there's little nuances. So for example, if I was to submit an offer, I might say that the due diligence window starts once I receive all leases or tenant acknowledgements, because now this is a commercial asset. Maybe there's 30 leases you have to verify, or 12 months of utility bills you have to verify. So you have to know a lot more about what you're going to need in that conditional period, because there's a lot of things, a lot of checks to go through. And then also there's a lot of sunk costs that can exist with commercial investing that might not exist in residential side. So for example, in commercial investing, your appraisal could cost you anywhere from $3,000 to $5,000. Whereas on the residential side, that might be free, there might be no appraisal, or it might be $300 to $500. So there's definitely some sunk costs that you have to be aware of. You might invest $5,000 to $10,000 in due diligence just to find out you want to walk away from a deal. So you just want to be prepared for what's to come, so you're not blindsided by anything in the process.
100%. Yeah, those upfront fees are definitely a lot more expensive. What other upfront fees should people be aware of when getting into due diligence or going conditional?
Well, I think that when it comes to commercial real estate, there's just a lot of costs that, again, these exist on the residential side, but they're not as impactful. So I'll give you an example. Carrying costs. So carrying costs when you're going through a duplex conversion or something like that, that might be a $3,000 a month mortgage payment for a period of 5 to 6 months. That would equate to maybe $15,000. Whereas when it's a commercial asset, those payments are a lot bigger because normally you're paying a much bigger purchase price. And a lot of times lenders might go, well, you have this 30-unit building that I know won't cash flow based on the numbers. So on closing, I actually want you to also provide an interest reserve. So now instead of just having your down payment, lending fees, land transfer tax, lawyer fees, now you have an interest reserve because you have to prepay 8 months of mortgage payments or 12 months of mortgage payments. So again, these are just costs you have to be aware of so that you're approaching the right assets in the right price point for you, or bringing in the right capital or right investors to partner with.
Mm-hmm. Oh, that's interesting you brought that up, actually, the interest reserves, because I was talking to someone else about it, and I actually literally did not understand it. So I'd love to actually, and if we can go into the details, because I mean, I get the general sense of it, but yeah, if you could kind of deep dive into how that works, or like even the purpose of it, because I wasn't fully understanding how interest reserves work.
Yeah. So let me frame it this way. If you go to a major bank to get a commercial mortgage on an apartment building, they're going to look at the income of that building and say, okay, based on the income of this building, it qualifies for a mortgage of $500,000 or $700,000. Now, the problem is the building you might be buying, maybe it costs $1.5 million. So a $700,000 mortgage is not very valuable to you because you'd have to put so much down payment down. So what you might look at is a different type of lender that are often called a repositioning lender. So when you're dealing with a repositioning lender, they'll actually give you a bigger loan to value generally than the major banks, as long as there's upside in the building and they believe you have the ability to turn over the building. Now, in exchange for giving you that large loan to value that building cannot pay for on a month-to-month basis, they want to make sure that you make 8 to 12 months of payments in advance because the building can't support it. So they make you make those payments in advance, and then they assume that by the time you get through that 12-month window, you will have turned over a few units, had some evictions. Now the rent will be high enough to help support those payments. Does that make sense?
Yeah. So when you do those upfront payments, let's say 8 months, like you said, but when you close, you're still making your payments, right?
No, no.
You're just like,
So you would
or you
have
actually have eight
no
months
payments
for
for that,
the
however many months you prepaid, essentially.
Mm. Oh, that's nice. Oh, that's really good. So that gives you time to just stabilize the property and prepare it and do the renovations and stuff. And you have your target of like eight
Yeah.
months.
So
Like I
if
can get my
you're
shit together.
So if you're taking on a multifamily asset, like you should be budgeting for that regardless if a lender is requesting the interest reserve or not. This is not something that you want to be like living, just getting to the next month and the next month of payments, because again, it can be pretty substantial. And then depending on the province you're operating in, you may or may not have great visibility into what the turnover will look like. So if you're in somewhere like Ontario and you're not getting vacant units on possession, you may think that you're going to go in and incentivize a tenant with money to leave, but you may be unsuccessful. So what happens in that case? So there's just a lot of factors that, you want to plan for in advance.
Yeah, but it's great to have that time frame to help you either like that, like get those renovations done. Because 8 months can like really help out in just getting things moving forward for sure. So
Yeah.
that doesn't impact anything the amount of interest you're paying. In either type of mortgages, you're still paying the same amount of interest. It's just that you're with a reposition mortgage, you have that 8 month grace period to just kind of get that stabilized as much as you can to start the payments in 8 months down the road. Is that right?
Well, every mortgage is going to come with different terms, different interest, things like that. In general, on average, a repositioning loan will be higher in interest than a conventional bank loan. So again, there's always a trade-off, right? They're willing to take more risk on an unstabilized asset. So in return, there is higher interest on the loan.
Okay, so what would you say on average then the higher interest would be like the increase amount, like an extra percent, 2%? Like what's your
I would say
average?
maybe if you're walking into a traditional major five bank right now to get a conventional commercial loan, you might be looking in the high sixes to mid sevens on interest rate. If you're looking to pick up a repositioning loan, you might be looking at prime plus one or prime plus two or prime plus 2.5. So that would equate to about maybe low nines to 10% in interest. So we're talking about potentially like a 2% difference between the terms.
Yeah. Okay. And then so when you're doing something like that, then what about like can something like that still like, go through MLI Select, for example, and will that bring down the interest? Well, I mean, I know MLI Select does that, but can you also, once you're done, also go through MLI Select or just a regular CMHC financing?
Yeah, absolutely. So you can a lot of these repositioning lenders are what are called like NHA approved lenders. So they're designated lenders who CMHC is willing to pay out when you go to refinance. And traditionally, if you're taking advantage or looking to take advantage of CMHC, specifically the MLI Select program, where you're adjusting the building to fit the parameters of the program, those are typically the type of loans people take on. If you're buying a building where it qualifies for a very high loan to value with a major kind of bank, then you're probably buying something more turnkey type thing.
Mm, okay, that makes sense. And now going back to again, we were talking about before the due diligence part, where you were discussing, just even making sure you understand what it is that you can get or where your parameters are with the mortgage, so you can decide what it is that you want to buy. What about like for the environmentals and stuff?
Yeah, so when
How
it
do
comes
you see that?
Yeah, so just for the people who are maybe a little bit newer to multifamily investing, so sometimes when you buy a building, they request an environmental assessment on the building. And there's different phases of these assessments depending on the risk level or what the initial assessments return back with. So generally, if you're buying a building that's in a residential neighborhood embedded around residential, you usually can get away with no environmental assessment or something of that nature. Also, depending on the size of the loan, if you hit a certain threshold, depending on the bank, it will trigger an automatic phase one and environmental assessment. Generally, a phase one is just a like researched assessment, so they're not actually going on site, drilling into the ground or things like this. But depending on the property, some things can be at higher risk of requiring several phases of an environmental assessment. I'll give you an example. If a property is across the street from a gas station or a dry cleaner, there's certain triggers that could lead you to believe that there would be an environmental issue with the building. So whenever you're in that situation, that's just something to use to your advantage in the due diligence period, because if it is a problem for you, the buyer, it will likely be a problem for another buyer. And generally, a seller who's working with a reputable realtor on the selling end, if there's clearly an environmental issue with the building, they would have already done a few assessments themselves to prepare it for market, so they know how that needs to be rectified. Hey, we've already done the phase two. It requires 15,000 of remediation for this purpose. Having that stuff up front lets the buyer know what they're dealing with.
Mm-hmm. Oh, that's great. That's great to hear. And I think age of the building also, does that matter for environmental, or that just even matters for mortgage itself, like even getting one, right? Something like
Yeah.
that. Do you want to speak to
So
that a bit?
generally when you're buying an apartment building, unlike residential, if you're buying a residential, a duplex, a lender's not going to say, I have to see the house inspection, because a lot of times people are not even doing house inspections on their duplexes and triplexes. They'll have themselves walking through and maybe that's good enough. If you're doing an apartment building, you're buying a $2, $3, $4, $5 million asset, you pretty much need to get a certified inspector to inspect that asset, and the bank is going to want to see the condition of that building. And again, all this kind of goes along the lines of they want to make sure that the building is safe, that they're encompassing any necessary repairs in their budgeting. So they might say that, for example, in order for us to release your first construction draw, you have to do all this fire code work that the inspector said needed to be completed in the next 6 months. So generally, they're just making sure that the asset is in good condition, because that's what they're financing based on, the asset specifically. So part of that is the rent coming in on the building every month and things of that nature, but also it's the condition of the building. So you'll want to have some version of an inspection, and what generally follows that is what they call a building condition report.
Okay. But so that so an environmental would never be on the age of the building, like if it's too old, that they would want to do it. That wouldn't be like one of their parameters.
I don't like it possibly could trigger an environmental, right? A lot of these buildings are pretty old, right? So I think that, all that stuff, it's generally just a case by case basis. Generally, the things that are triggering environmental are the surroundings around the building. And then in addition, just the price point. At a certain price point of acquisition, they're doing every due diligence they can, kind of thing.
Okay. And then I guess it's more, then it sounds like it's more once you're hitting the mixed commercial or just full on commercial and not residential. Is that when you are really, it triggers more the environmentals where it's like all the time,
Yeah,
or?
it's really just anything that gives the lender an indication that there could be something of concern. That's going to increase the likelihood of that being a requirement. So what are those things exist of? Like I said, the neighboring of the property, what's in the area, the usage or former past usage of the property. If something was used as an auto mechanic shop in the past and now it's a straight residential building, that's certainly something they're going to want to look into. So all those things play a factor, but all these things are not, they're not really things that we can't project in advance.
Oh, that's good. So you can project if you by knowing the address, you'll know already what needs to be done with it.
Yeah, you can flip it over to a couple lenders or people you're working with, and they'll generally give you an idea saying, hey, that should be fine, or know what, based on the region, we're going to want such and such.
Mm-hmm. Any other changes that you would like, or sorry, not changes, differences you would like to discuss about going from the small multi single family to the bigger?
Yeah, I would say that there's a lot of benefits. I would say one of the big benefits is that when you're taking on partnerships, that commercial is a lot more conducive towards partnerships than residential is. So if you want to set up a GP-LP structure where you're raising money for your down payment and raising money for your renovation costs, that's totally allowed and on side on the commercial side. Whereas if you're pursuing residential financing, often anyone who's financially tied to the deal, they want them on the title and on the mortgage application. So that is not always the easiest thing to work out. In addition to with commercial, is that they won't necessarily just lend to anybody. If you have the borrowing power and you have the down payment, they will let anyone buy a duplex. When it comes to buying a 50-unit building, they're not going to let just anyone buy that if they have no experience turning over those types of assets. So experience is actually an important thing when you're buying commercial. So if you are somebody who has a lot of money, you might want to strategically bring somebody into your partnership team who does have that experience so that you're not running into any roadblocks in the financing process.
That's a really great tip because I think, especially on the private side, people will buy and use, let's say, private mortgages. And I don't know if they've done, maybe they have done. I feel like some of them didn't though, because then they have so many problems going to like an A or B lender or, a commercial type of lender. And then they're having so many problems with it. And it probably could be not having the appropriate experience and giving the lenders the confidence they need. What would you say would be the base, maybe 3 or 5 things that you think that people should be aware of? Let's say even for finding a partner or themselves seeing if they actually do qualify, what would be the things that you should kind of pay attention and even maybe provide, I guess, to the lenders?
I think that when I usually say this for most people is if you're looking to jump into commercial multifamily investing, preferably you've done at least 3 deals on the residential side and preferably deals that involve raising some capital, evicting tenants, and doing renovation. Those 3 things are things where if you have no experience in those 3 parameters, and now all of a sudden you're taking over a building and it needs 20 renovations, not 1 or 2. It needs, 10 out of 20 evictions, not like your first eviction. It needs raising of $500,000. Like, it's really important to have a bit of experience. And I would say get your feet wet on the smaller residential side before you jump into the commercial investing. Now, are there people who have just jumped right into big projects on their first deal and had a lot of success? Sure, there are definitely a lot of people who have done that, but I think getting your feet wet in the smaller space definitely sets you up for most success. And also just like dealing with people. If you've never dealt with contractors, you've never dealt with blue collar people before, there's a lot of learning with that experience. Dealt with getting quotes, like having an idea of whether something makes sense or doesn't make sense. So I think that you just want to get your feet wet in the smaller space, and then you want to work with somebody who has actually done the commercial investing before. So your realtor, your mortgage agent, they all have to have kind of done the investing before so that they can kind of hold your hand through the process and give you honest advice, right? If you have somebody who's a mortgage agent or a realtor and they don't actually know that much about commercial, they just might be getting excited about getting a large commission on your deal and not actually knowing that your deal is going to become a big problem the way you're approaching it, and it will eventually become their problem. Mm-hmm. So for somebody like me, if I'm looking at someone's plan and I'm like, whoa, like, what about money for this? What about money for this? What about money for this? Like, I'll make sure that you actually like are planning what you're supposed to be planning. So I think just having the right power team in place. Again, commercial's not something you can kind of figure out as you go. It's something that requires a lot of preparation.
I love that, especially what you said about the contractors, because that's one of the biggest things, the biggest problems I see, especially with like that new investors, is they have this expectation as if the contractors take care of everything and like don't even have to communicate very much with them. And then they wonder why the result is so different to what they expected. Or even like just finding wrong contractors. That happens all the time that don't don't do the things that you need because either they don't have the experience or you didn't do the proper vetting for them. So I love that you said that. And also that being said, it also I feel like, and I'm curious, you guys tell us, but it also doesn't seem the criteria doesn't seem too scary. You know, I feel like most people probably have done at least like the ones that are going into the bigger multis, like you said, two or three projects already have done it. And so I feel like that kind of and then the capital raising, I feel like it's not, because I feel like capital raising is probably a lot easier on this, again, on the smaller side, like at least to like get your feet wet and stuff than it is in the bigger. So it doesn't even seem that scary too, which is I think is good because I feel like some people just like you hear like, oh my God, I need to have experience. I mean, you should and probably find someone like you said, but at least it doesn't sound so daunting to people where it's like, okay, I could, it's like an easier goal to achieve.
Yeah, and I think that, like I bought 20 something res properties, and I would say I probably did that with napkin math and just ripping through transaction checks because it seemed really simple. But when it comes to commercial investing specifically, like you need to build in way more contingency, right? Especially in Ontario. So for example, a building I bought recently is about 18 units. And when we bought this building, the tenants were having meetings about new people bought the building and they're going to try to kick us out and all this type of stuff. So that's a big contingency to plan for because now maybe we were thinking we were going to be able to turn over 1/3 of the building or 2/3 or 100% of the building. What happens when you're short of that goal? What happens when you're 80% of that goal or things like that? So depending on your approach to how you plan on refinancing, all that stuff's going to play a bit of a factor because generally if you're looking to take advantage of energy efficiency with the MLI Select program, there's going to be a large fixed cost associated with the energy improvements. And you got to make sure that you have enough turnover where your variable costs and your variable profit margin like is enough to cover those costs you took on to improve the efficiency of the building. So you really just need to plan for a lot of different hypotheticals. Again, on the smaller res side, there's just really not that many potential hypotheticals. And I think that's the big difference between the two fields.
Yeah, that's a great point. And even just in renovations, like that, like you, let's say budget, I don't know, 20 grand per unit, and then all of a sudden all these major costs come in and that extra, let's say $5,000, $10,000, even something like that can all you have multiplying that across all the number of units becomes a lot more expensive.
Yeah. And then you factor too that these projects aren't necessarily 30-day projects or 60-day projects. They might be 12-month projects or 24-month projects. And then what could happen in the next 12 months or 24 months that may impact this project? Well, we've seen interest rate changes, right? That can move in a positive or negative direction depending. You could see policy changes. You might be doing an entire project based on one financing policy that exists right now. And then 6 months into your project, that policy no longer exists. So there's a lot more contingencies you have to budget for. And that's just something to think about before you jump in.
And that's a great point because I mean we've seen, like you said, policy changes in the last few months, almost a year probably now. Yeah, probably a year, right? That I feel like mortgages have been changing so much that, like you said, you have these beliefs that you're going to get these different things done and you're going to be refinancing at this with these terms and then all of a sudden maybe that doesn't even exist anymore or the terms are much harder or whatever. Like you said, things have changed.
Yeah, so there always has to be a version where you can sell the property at a profit. Like there always has to be that version baked into your agreement. So it's similar with all forms of investing. Like you really make the money when you buy the asset, not when you do everything else to it. Because if you can buy it at a price that allows for all this contingency and allows for things to go wrong and allows for a margin in the future, that's when you're most protected.
Mm-hmm. Mm-hmm. Yeah, completely agree. I love that you said that. That's so important. Any other things that you wanted to discuss about differences between the two or things that we should be expecting?
Well, I think that the main thing is that if you're somebody who's looking to jump into this space, definitely please reach out and I'm happy to kind of walk you through step by step. Hey, here's where you're at right now. Here's what you need to start exploring next. But I would just say embrace it because the big benefit of commercial, and I think the big difference with commercial and res is that on the commercial side, you don't have the same limitation. It's not like, oh, I just got a mortgage. I may only be able to get one more until I no longer have borrowing power, or I plan to quit my job and be self-employed, so I'm no longer going to have borrowing power. It's not like that on the commercial side because the assets are financed based on their financial performance and not based on your T4 income or your business income or things like that. So I'd say that, make the leap at some point, because then real estate investing, the door is going to kind of open wide open again, and you're going to be able to continue to scale and not have that feeling of this may be my last property, which often exists on the residential side.
Mm-hmm. Yeah, I love that. That's also a really great tip, and I feel like it's always, especially with the bigger properties, spend that money to just make sure you know what it is that you're doing properly. Because the first one may be very expensive, but you'll learn a lot from it. And then things I feel like you'll be better at making better decisions, or for example, like renovations won't be so expensive because now you've kind of learned it at a bigger scale because there are still differences and things like that. So I love that. Another thing that I wanted to touch base on was because you were speaking about finding someone in the commercial side that is experienced. Now, what would you recommend as a vetting process to be able to find that person? Because a lot of people, for example, will go think they're with someone who has experience, and then all of a sudden doesn't go that well because maybe they inflated what they said, or who knows. So what would you recommend?
I think it comes down to asking specific questions. So a lot of times people will, say something vaguely or say it with a gray area. So, for example, if it's, hey, my clients have done all these types of deals before, that doesn't mean that that person has done those deals before. So, just asking your realtor, asking your mortgage agent about their personal firsthand experience with multifamily real estate. And then once they say, oh, yeah, I bought this 20 unit in Ottawa, or I bought this, 30 unit in Windsor, or things like that, I would then ask more questions about the process. Okay, when you bought it, what kind of mortgage did you use? Why did you use that mortgage? What were the renovations you had to do? Did you hire a contractor? Did you hire trades individually? Did you let the property management company do it? Ask those questions, because people may actually have ownership in projects, but they weren't the driving force behind the project. They were maybe a passenger on the team, right? So you just want to be able to ask questions and get answers that make sense to you. And if those answers don't make sense to you, just ask further clarification. And it might be that the answers don't make sense because they don't actually make sense. What the person is talking about, maybe they weren't actually the one doing things, and that's not actually how it shook out. So I just think asking specific questions about their projects, and anyone who has done this kind of stuff is usually very eager and happy to share, kind of thing. And I think that's how you'll get your vetting done.
Yeah, that's great because it's true. Once I actually, it's funny you say that. That is a very big trigger. It's very easy when it's like they start talking about, I feel like the team and not I. I feel like it's like, okay, so who on that team is actually doing it because you'd rather talk to them.
Yeah. Mm-hmm.
Yeah, so that's a great tip. But what about, or maybe I misunderstood, but what about also like uh or maybe it is fine actually if your power team has it. But do you have any tips for, because I thought when you were also talking about that, you were also talking about like if you're joining like an actual partnership with someone and someone that specifically has done commercial. Is that, were you talking about that before too? Like I was wondering what is the vetting process even, let's say for those type of
For
people
bringing a partner on your team.
that like if you don't have
Mm-hmm.
experience in buying commercial property and you want to find a partner that has bought a commercial property, or if you like, what kind of vetting would you do for that?
Yeah, I
And would it be
think that
the same?
that's a tough one. I think you want to have an idea of what you bring to the table, or what you're planning to bring to the table, and then just have open, transparent dialogue with people that you connect with, right? Go to the networking events, see who you're, having good conversation with, and start to kind of filter it out from there. You certainly don't want to be partnering with just anybody who's willing to partner with you, especially in commercial. It's a longer term partnership. This can easily go 5+ years. So I think it's important to work with people you actually want to work with, someone you actually have like a fun banter with, dialogue with, you can laugh at things with in like the tougher moments, but just having transparency, right? So learning about their projects, learning what their expectations of you as a partner would be, and vice versa. And then I think from there, you can continue the dialogue. The other version you can do is tie up a really good deal. And then based on that deal, you find the partner who fits best for that deal. Because potentially you negotiate, or you set up plans to build a partnership with someone who has a lot of experience in the Windsor region, and they have a contracting crew down there and they have connections and all this kind of stuff. But then you just happen to find the perfect deal and it's in Ottawa, Ontario, and maybe you're better off suited with a partner in that direction. So I would say have the loose dialogue, set some parameters in place, and then let the deal be kind of like the final piece that dictates what direction you go in.
Mm-hmm. Yeah, I love that. And so for when now that you're going through the process of the due diligence, anything in there that you feel that, I mean, that we haven't obviously already spoken about, that you'd want people to be aware of going into due diligence?
Well, the number thing you have to be aware of is timelines, right? Like how long do you realistically need in order to satisfy all your conditions of the due diligence? But outside of that, if we want to talk like a lot more nuanced, I'll give you a big one. So let's say you are buying a building in Ontario. Ontario is notoriously a very hard province to turn over buildings over because the landlord tenant rules are very much so in place where there really is no reason a tenant has to actually leave these buildings unless you're actually developing the building, going to be doing some serious intrusive work and you can serve them notice. So what I would really want to do is in your due diligence period, get access to as many units as possible. Sometimes you're only going to be able to get access to 33% of the units or 50% of the units, but try your best to get access to 100% of the units and really take a full note of the entire tenant profile in the building. Because I'll give you an example. It's a lot easier for somebody who's making or who's paying $1,200 a month to move to an apartment where it's paying $1,600 or $1,800 a month, because a person paying $1,200 a month probably is working. But if it's somebody who's paying $600 a month and they now have to jump into a unit that's at $1,300 if they left or something like that, those people are going to be a lot more reluctant to relocate and not as willing to accept some version of a negotiation to leave. So I think you really want to go through that due diligence period and figure out what is the profile of the tenants. Are they even in a position where they could relocate and pay rent somewhere else? And let that really factor into your plans on how much of a turnover you're going to get in the building. So learn as much as you can about the tenants during the due diligence period so you kind of know what you're getting yourself into.
And I guess in that sense, you're talking about actually like having conversations with the tenants,
Yeah,
right?
how long have
Because I feel
you
like you
lived
wouldn't be able
here?
to be like, hey, can I get your like employment letter?
Yeah, no, but I would say, hey, how long have you lived here? Do you work? What do you do? Blah, do you want to stay? Is there any issues in the building you would like us to repair that are currently a problem in the building? Is there anyone who's bothering you in the building? Stuff like that kind of thing. And just get an idea of what you're walking into. Again, this is the purchase of like a multi-million-dollar asset that, according to the government, you do not have full control of. So you want to uncover as much information as you possibly can.
And I feel like those questions are really good for the ones that are already leaving. I remember once we went to go see a building, and they were basically the guy that was leaving. Like he told us so much about the building and like all the changes, because he also was like a long term. I think he had there for 15 years or something. So I feel like those ones are always the best ones to go to. They're most open because they don't care because they're leaving already anyways.
Yeah, yeah.
That's awesome. That's great to be able to do that, because it is, and to even think of those asking questions, because a lot of people actually don't even, because I think it's very, very important, and I'm sure probably you probably agree to this, is like actually getting into every single unit before you finish your conditional period, because there are people who won't actually do that, or they'll go through maybe like 50% of them or a few of them, and they accept it that way. And it's like these kind of things can be, so what help, to be honest, with the negotiation if you need to bring down the price of the building because of things that were unforeseen. But it's also just like it can change so many things. It's like the renovation budget could be changed. like you said, like the tenant profile, you may start even adjusting the way you think that you'll be able to be changing it or being able to like what your turnaround period would be. You probably, like you said, like with that conversation, you can really actually learn a lot about even what you can do.
Yeah, absolutely, right. And a lot of tenants will say, "Hey, yeah, I'm on this rental assistance, and it would pay it directly to you," and all this kind of. It's just good to get to know what's going on in the building. And again, you'd be surprised what you come across, right? It might be that, wow, these units are actually very clean. Now, all of a sudden, when one of the tenants wants to relocate from unit on the third floor down to the first floor because it's better for their knees or whatever, you're like, oh yeah, unit 33, they actually kept it really clean. No, that was a good tenant. I am willing to relocate them to another building in our unit. So the more you know, the better. And generally, tenants are people. So the better rapport you can build with them, the better situation you can create for both of you.
Mhm. And even one of the things that I've noticed too as coming in, I mean, I've never done the big multis, but I feel like this will probably translate the same, is when you go and meet them and talk to them, if they do have a grudge with the previous, I feel like they're usually very much willing to, if you come in it the right way, they're very much willing to like share everything that's been going on. And if you're able to like maintain that relationship, almost sometimes you could start from scratch, and they'll be actually willing to work with you, because I mean, and obviously you have to prove to them that you are going to help them out or whatever the problems were. But I feel like that also sometimes becomes an advantage, is like if there is a grudge with someone, usually having them talking to someone completely different can really flip things around for them and you in so many different ways.
Yeah, absolutely. I mean, there's a lot that goes into managing these buildings and things like that. So it's definitely it's definitely helpful to get just as much information as you need, kind of thing. But again, so if you're somebody who's looking to get into commercial multifamily, it's just re-educating yourself on the real estate process. The good news is that you have a lot of experience in all these things already, but it's a matter of just learning the rules of the game and how you can make deals work. And if you're finding that you're looking at things and you're like, I don't really see the number. I don't see how the numbers work on this. Well, it might just be that the deal you're looking at, the numbers don't actually work. And you're right. And just move on and keep looking for the deals that do work. Because I think that's the big thing is a lot of people are used to doing duplex conversions, triplex conversions, and they start looking at these bigger multifamilies and they're like, I can't even make sense of these numbers. But again, it's just like residential. Most deals aren't going to look that attractive. So just keep doing due diligence, keep figuring out what thresholds make the investment work for you, and you'll eventually find a good deal.
Hmm. Love that. And I know we spoke about like the closing costs. I don't know if we went into detail. What did we talk about? What actual, not cost wise, the amounts, but is there anything extra in the closing costs that, let's say, you wouldn't see in the in the smaller, in the singles and multi-families that you should be taking into consideration?
Well, certainly it depends, right? But there's going to be a lot of things. So again, the interest reserve is probably the biggest cost on closing. And again, it's not really a cost, it's more a prepayment, but that's the biggest probably capital allocation that just doesn't exist at all on the residential lending side. You're still going to have things like down payment, fees, appraisal costs, land transfer tax. It's just that all these costs are going to be much larger when the asset price is much higher. So one thing to be aware of and just a budget is like if you're looking at a $3 million plus asset, just buying it in Ontario alone is going to result in a way bigger closing cost because we have land transfer tax here. Whereas if you go somewhere like Edmonton and you're buying a building that, I think my last deal, I bought one in Saskatchewan recently, and had I bought that deal in Ontario, I would have $50,000 extra in closing costs just in taxes, right? So it's
Mhm.
really just breaking down all the different costs, and then there might be other things that you're raising money for. So let's say you're really trying to make your multifamily investing a business and build a profitable business that you can live off of based on it. You might build an additional cost in your capital raise. It might be an acquisition fee for finding the building. You might have a markup of the construction cost. You might say, you know what, I'm managing a $500,000 renovation. I need to budget an extra 4 to 8% to pay myself for managing this renovation. You might actually build in a contingency of 1 to 2% extra for managing the property management company. So depending on how you're approaching the deal, there might be more things to factor in your closing costs or in your capital raise for the closing costs, but that's going to be dependent on how you approach the project.
Yeah, I love that. Actually, that's true. Because even, for example, like accountant, to get the stuff done, like yes, you hire an accountant, but they still need stuff from you to get everything done. And there should be like a little fee because it does take your time to actually even the things that you need to give or the back and forth that happens. And another thing I wanted to also say was, because isn't it in general when you're going in commercial, and it doesn't happen with the A lenders, is that also you're usually the broker fee and the amounts are also, aren't they different too? Like normally the broker fee comes from us compared to like an A lender where the A lender is paying the broker,
Yeah,
or
so
does that also
if
vary?
you're doing a deal at like a traditional bank on the residential side, on the A lending space, typically there's no fees being charged because the lender is paying the mortgage agent a commission. Then if you work with alternative lenders, it's a little bit different. Some don't pay commission, some pay very small commission, and they also charge lending fees. And those types of deals, it's not uncommon to see a mortgage broker charge a broker fee on those kind of deals. Then when you go on the commercial lending space, it depends on the type of lender. Some lenders charge lending fee. Some lenders just charge what's called an application fee, sometimes smaller than what you traditionally see in the lending fee. And then mortgage agents who are brokering those directly, they're not paid by the commercial banks, so they'll typically charge a broker fee. Now, what that broker fee is going to probably vary depending on the complexity of the deal, I guess, kind of thing. So
Mm-hmm.
if you're somebody where you're doing a purchase, then you're refinancing into a bridge loan, then they're taking you into another refinance. They're probably going to do something for you on the fees to make it reasonable because there's like 3 transactions going on here. But in general, I'd just say everything is just heightened. The fees are higher, the due diligence is higher, the timelines are slower, but the distance you can actually go with your portfolio is much further. And that's kind of the
Mm-hmm.
benefit. I think the big benefit of commercial also is just when I'm 60 years old and I have an apartment building with $3 million of equity in it, I can refinance and access that equity, and the building's going to pay for it. And I can take a big check in my pocket. Whereas with the residential financing, and when I'm 60 years old and I'm not showing income on paper, I'm not going to be able to refinance that at 80% loan to value at a major bank. So those are the benefits. Is I think this commercial stuff is really going to help you in retirement, or it's going to help you whatever career path you're going to pivot towards. And that's the big limitation on the red side.
That's a very, very good point that I actually never thought of. Because even as self-employed, like if you're just full time in this and maybe haven't started receiving an income for it, or maybe just, I don't know, everything's in corporations, there's just not much, whatever it is. But there's so many situations where maybe you're not making money. And like you said, that the commercial loan, they'll still let you refi 100%. Yeah. In the residential side, to be able to do a refi probably won't help at all. So I think that's a very good point that you put that because it does make you start realizing even like that the benefits of the commercial loans. Because also you can actually bundle up your properties. I mean, I know this is off topic a little bit, but you can bundle up a few of your properties to also kind of do the same thing, put it into the commercial side, which if you're making good money profits on there and you're treating it like a business and you're getting that cash flow, in the same, you can probably refinance it in the future. But because you have so many more units and what bundled up.
Yeah, exactly. And the thing is that with these multifamily assets, they qualify for better loan terms, right? So what you're kind of referring to is a portfolio loan. I have 10 duplexes. I could bring it to a commercial bank, but I can't take those 10 completely separately titled duplexes and take it to CMHC and get a 50-year amortization and 95% loan to value. So the asset type is allowing you to get better loan terms, which is allowing you to cash flow with higher mortgage amounts, which means you can get more money in your pocket. So definitely, if you're looking to keep scaling with real estate, it's a great avenue to get started in.
Yeah, I love it. Any final words before we finish off that you like to share about yourself or just the final tip or overview, whatever you like to share?
I would just like to share honestly that everything is possible. Like I started investing in real estate with just, I think I had $15,000. I was 22 years old, and I thought I knew everything. I knew absolutely nothing. And that was a time where there wasn't all these people on YouTube that you can just reach out to and ask questions to. So the information is there for anybody who wants it. And it's certainly possible for anyone. You just have to get started and be willing to actually work. I think a lot of people where they just have the idea to invest in real estate and they think the universe should all conform towards bringing them a great opportunity. Well, it's not really that simple, but if you decide to put in the work towards pursuing this, real estate investing is something that could definitely be possible for anyone.
Love it. Yeah. Definitely doing the work. A lot of people think like, oh, I'm just gonna put the money into it. And they think it'll like happen so quickly, and it's definitely work is very important. Jacob, thank you so much for coming on. If you guys love what you heard from Jacob, follow him. I'll be tagging him on here so you'll be able to follow him, see what he's up to these days, his projects, the mortgage side. And if you guys loved what you heard from me and you love these shows, definitely follow me. You can stay tuned to all the different shows that I have coming up. Jacob, thank you so much for coming on.
Thanks for having me.
Awesome. Bye, everyone. Bye,
Take
Jacob.
care.